Hello all, welcome to another exciting session of School for Becoming Smart Investor. In our previous class, we learned about what is fundamental analysis, which is particularly used to forecast the future stock prices by calculating the real value of the stocks. Now, one of the important part of this fundamental analysis is the economy analysis. This economic analysis is used majorly to understand the economic growth and how does that affect our stock prices. Now, when you talk about economic analysis, there are major factors or major parameters which we need to consider, such as political stability of the country. Now, when you talk about political stability, this is the most important factor which directly or indirectly affects the entire company, economy, various industries, and ultimately the stock prices. Politicians are the real policy makers. Their job is to make policies and amend laws for overall welfare of the citizens of the country. They also have to monitor how effectively the bureaucrats are governing the country. In today's era of globalization and connected economies, not just for our country's political stability, but political and economic stability of other countries of the world, especially developed nations, emerging economies, etc., is equally important. Now, another factor which is part of economy analysis is the GDP, gross domestic product. Gross domestic product is a monetary measure of the market value of all the finished goods and services produced in a period of time. This period is usually a year or a quarter of a year. Whether there is an expansion in GDP, that is increase in GDP growth rate, or GDP growth rate is above the consensus of market expectations, corporate earnings tend to increase, which leads to overall increase in the stock market. The inverse happens when there is a contraction in GDP. GDP growth rate declines or GDP growth rate is lower than consensus or market expectations. The next factor, which is part of economy analysis, is Index of Industrial Production (IIP) data. The Index of Industrial Production is a composite indicator that measures the change in the volume of production of a basket of industrial products during a given period with respect to the volume of production in a chosen base period. Further, all the items included for calculation of IIP are classified into three broad sectors: manufacturing, mining, and electricity. Just like GDP growth rate, when IIP growth rate is above consensus or market expectations, corporate earnings increases, which leads to overall bullishness or increase in the stock market. The situation is opposite when there is a contraction, that is decreasing growth in IIP. IIP growth rate declines or IIP rate is lower than consensus or market expectations. The next factor, part of economy analysis, is the consumer spending. Now, the consumer spending is the amount of money spent by the households in an economy for durables and non-durable goods. As the economy progresses, there is rise in income levels of the people at large, and hence, with more money at disposable, consumer spending increases. Hence, any significant increase in consumer spending is seen as a good indicator of booming economy and vice versa. The next factor is inflation, which we need to consider as a part of economy analysis. Inflation is the rate at which the general level of prices for goods and services is rising. This results in fall in purchasing power of the currency. Inflation causes rise in prices of energy, food, commodities, and all other goods and services. This in turn impact the cost of living, the cost of doing business, borrowing money, mortgages, corporate and government bond yields, and hence affect the entire economy. Reserve Bank of India (RBI) tries to control the rate of inflation in the economy through its monetary policy by raising or lowering the policy rates such as CRR, SLR, repo rate, bank rate. This results in increase or decrease in the interest rates or lending rates. which ultimately affects the interest rate on inflation and overall economy is explained ahead. The next factor, which is part of economy analysis, is interest rate. The interest rate, also known as lending rate, in the interest that will be charged for borrowing money, expressed as a percentage of the total amount of the loan. When the economy is booming or growing, the consumer confidence and spending increases and it often leads to inflation. And to control inflation, central banks often hike the interest rates. Similarly, when economy is contracting, consumer confidence and spending reduces. And it often leads to deflation or reduction in inflation. And under such circumstances, central banks often reduce interest rates. Now, how does this effect of interest rates on the companies? On As the interest rates are reduced, cost of borrowing for the companies reduces. This increases the corporate earnings as it reduces the interest expenses of companies on their existing debt. It also promotes them to take additional debt for adding on additional capacities, thereby creating more jobs and resulting in growth in overall economy. Now, how does this interest rate affect the consumers? Okay, on when the interest rates are increased, people tendency to save money increases as they get better returns, and at the same time loan becomes expensive, hence they avoid taking them. This results in reduced consumer spending, causing the economy to slow down. This ultimately results in decrease in inflation. The next factor which affects, which is part of economy analysis, is the agriculture and monsoon and how that affects these our stock market. Agriculture and monsoons have a great impact on our overall economy of our country. The Indian economy is heavily dependent on agriculture, and the livelihood of the Indian farmer largely depends on the monsoon rains. Roughly around 70% of Indian population directly or indirectly depends on farming. Around 60% of the total employment in the country is through agriculture, and most importantly, the agricultural sector contributes about 17% to the total GDP of our country. A poor monsoon not only leads to weak demand for the fast moving and consumer goods, two wheelers, tractors, rural housing sectors, but also increases the imports of essential food staples and forces the government to take populist measures like farm loan waivers, thereby putting further pressure on country's finances. Thus, it is safe to say that monsoon does play a big role in India. The next parameter which affects our or which is part of the economy analysis is the government budget and deficit. Every year, our government prepares a central budget which provides complete information on revenue, expenditure, and deficit of the government for the given period. Government revenues comes from various direct and indirect taxes, and government expenditure happens on various developmental activities. A fiscal deficit, also known as current account deficit or the budget deficit, arises whenever a government spends more money than it brings in during the fiscal year. Each year's fiscal deficit adds to the debt of the country. As the debt of the country grows, it increases the deficit. Global rating agencies put a premium on lower fiscal deficit number. Hence, a lower figure of fiscal deficit is always desirable, as it allows the country to mobilize more foreign capital, which is the key to rolling out infrastructure projects and driving the economy higher. The next parameter, which is part of the economy analysis, is the new corporate tax structure. So, what is the present corporate structure? We need to keep an eye on it. A corporate tax is a tax levied on its corporate earnings. It is one of the major sources of revenue for the government. The rate of corporate tax has an effect on economy. The balance between the cutting corporate taxes and ensuring the economic growth is a fine one. Although in short term, it may reduce government revenues, thereby increasing the fiscal deficit, but in long term, It attracts more foreign investments, develops more businesses, and has a positive effect on the GDP. The next parameter or factor which is part of economic analysis is the balance of payment, forex reserves, and exchange rate. These three factors are interrelated and have an impact on the economy. Balance of payment of a country is a record of all the economic transactions between the residents of the country and the rest of the world in a particular period of time. This difference in receipt and payment may be deficit or surplus. A balance of payments deficit means the country imports more goods, services, and capital than it exports. Whereas a balance of payment surplus means the country exports are more than it imports. Balance of payment has an impact on foreign exchange reserve of a country and hence its exchange rate. The surplus balance of payment augments forex reserves of the country and has a favorable impact on the exchange rates. On the other hand, its deficit increases, the forex reserves depletes and has an adverse impact on the exchange rate. Hence, the favorable balance of payment is good for any economy. The, the other parameter which is part of the economy analysis is the infrastructure facilities. Infrastructure is the base on which economic growth is built upon. Building of infrastructure facilities not only results in faster economic growth but also helps in alleviation of the poverty in the country. Infrastructure facilities and arrangements play an important role in growth of industry and agriculture sector. For decades, India lacked infrastructure facilities, but things have now been changing, and hence the pace of building infrastructure facilities has increased rapidly in last few years. Thus, it can be concluded that state of infrastructure is one of the most important factors of economic growth, but doing all this is not an easy task. Building infrastructure requires huge investment and their gestation period is quite long. That is, their benefits are witnessed over a long period of time. The other factor or another thing which is part of economy analysis is the demographic factors. Demographics are characteristics of a population. Some commonly used demographic factors include variables such as age of the population, literacy, occupation, income, marital status, religion, education, family life cycle, socioeconomic states, age, gender. A country like India having a proportionately large young and working age population and an increasing middle class population can grow rapidly if it makes effective use of this demographic advantage. These favorable demographics can help in creating demand, income growth, and higher savings. On the other hand, a country like Japan, despite managing such a high standard of living, technological excellence, and so on, it is unable to grow the economy due to an aging population. The next important analysis, which is part of economy analysis, is the sentiments. These sentiments of a consumer and business managers can have an important bearing on future economic growth. Higher consumer confidence leads to higher consumer spending, and higher business confidence leads to greater business investments. All this ultimately leads to economic growth. Likewise, in financial markets, market sentiments play an important role as the overall attitude of investors towards a particular security or the broader financial market. If the economic conditions are expected to fall heavily and suddenly in the future, then lead to a fall in prices of stocks and other assets. Reduction in business investments and currency depreciation, all this eventually lead to fall in the economic growth. So my dear friends, that's all for our today's video. In our next class, we'll learn about how to and what is industrial, how to perform an industrial analysis and what is industry analysis. And then after that, we'll talk about company analysis and how to perform company analysis in order to predict accurately and build confidence on a particular stock. Thank you all. Thanks for watching. Please subscribe and like and share.